Hi, Assalamualaikum, and a very good morning. My name is Amir Muqtasim bin Omar. I am Muhammad Aiman Hakimi bin Muhammad Ridwan.
Hi, my name is Nakib Amshar bin Ibrahim.
And I am Muhammad Amir Fahmi bin Muhammad Arif.
Today, we as a group are going to present the segmental reporting and interim reporting of YTL Corporation. Company's background. YTL Corporation Berhad is an integrated infrastructure developer with extensive operations in countries including Malaysia, Singapore, United Kingdom, Australia, France, Indonesia, Japan, Jordan, Myanmar, Netherlands, Thailand, and also Vietnam. The core businesses of YTL Group comprise utilities, construction contracting, cement manufacturing, property development and investment, hotel development and management, e-commerce initiative, and internet-based education solutions and services. YTL Corporation is amongst the largest companies listed on Bursa Malaysia Securities Berhad, which is the Kuala Lumpur Stock Exchange. YTL Corporation has also had a secondary listing on the Tokyo Stock Exchange since 1996 and was the first non-Japanese Asian company to list on the Tokyo Exchange. Furthermore, the YTL Group is committed to producing world-class products and services at competitive prices. This corporate philosophy has enabled the YTL Group to build up a growing customer base of more than 12 million customers globally over the last 30 years. Since 1955, YTL has been in the business of nation building. Building is at the heart of what they do, from building schools, hospitals, and national infrastructure in Malaysia to provide electricity, water, sewerage and environmental services, cement and building materials, education technology, homes and award-winning hotels, and luxury resorts worldwide. Their work stands the test of time because they turn the right opportunities into the right thing, and the right thing into lasting value. YTL is about building value that is not simply lasting, but worthy of lasting. Additionally, their family values have made them stronger and kept them together, as well as allowed them to be where they are today with confidence. Honesty, hard work, moral responsibility, togetherness, and vitality. These core values are the essence of who they are and defines what they choose to do. The compass that points them to do the right thing. YTL, building the right thing. On to the next slide. Management approach. There are three types of management approach, which are factors of having segment reporting, shift of decision making and its responsibilities, and the last one, types of segments in YTL Corporation. In this slide, let's talk about the factors of having a segment report. First and foremost, the nature of business activities of each component, to the extent that the higher level segment information is represented by components that contain the similar business activities, while the lower level components contain similar business activities. The lower level components may be more representative of the company's operating segments. Secondly, the existence of managers responsible for each component. It is likely that those components that have individuals responsible for the component's result, such as a segment manager, business unit CFO, or vice president, and who are directly accountable to and maintain regular contact with the CODM to discuss operating activities, financial results, forecasts, or plans for the segment. Segment managers may be responsible for more than one operating segment. Lastly, the information provided to the board of directors. The information provided to the company's board of directors, when not considered to be the shift of decision making, may indicate the level at which overall performance is assessed and decisions are to be made about the resource allocation to different areas of an entity's business. An excellent company must have great leaders. So, in this slide, I am going to present to you the shift of decision making and their responsibilities at YTL Corporation that makes them a great company. First, we have Datuk Sri Michael Yoh Sok Siong. He is primarily responsible for the YTL Group Manufacturing Division, whose activities involve cement manufacturing and other building material industries. Furthermore, we have Tan Sri Sir Francis Yoh Sok Ping. He is also the chairman of YTL Starhill Global REIT Management Limited. Then, we also have Datuk Yoh Sok Hong, who is responsible for developing the power and utility businesses of the YTL Power International Berhad Group. In addition, Datuk Mak Yoh Sok Kah, who is presently the Executive Director responsible for the YTL Hotels and Resorts divisions. And last but not least, Sheikh Abdullah bin Sheikh Abdul Qadir. He serves on the boards of YTL Power International Berhad, which is listed on the main market of YTL E-Solution Berhad. And then, that's all from me. I will pass this presentation to the next presenter. Assalamualaikum.
Assalamualaikum. My name is Muhammad Amir Fahmi bin Ma'arif, and now I will continue with the presentation. So in this slide, I will be explaining on how to identify if the segments are reportable or not. To identify the reportable segment and the non-reportable segment, we need to calculate the 10% threshold test first. In the 10% threshold test, there are three bases or approaches that we can use, and which are revenue basis, profit and loss basis, and assets basis. For reporting a segment needs to pass the 10% threshold test through any three bases of any approaches to qualify as a reportable segment. First, the revenue basis. Revenue basis consists of internal and external revenue reported from one segment, and it should be equal or more than 10% of the total revenue from all segments. Next, we have the profit or loss basis. The total amount of profit or loss of the segment must be equal to or more than 10% of the combined reported profit or loss of all segments. The third and last basis is assets basis. The total assets of a segment must be equal or greater than 10% of the total assets of all operating segments. So, what will happen if the segment does not qualify as a reportable segment? A segment that does not meet the criteria of the threshold test can be identified as a reportable segment despite its size, and it can be combined with other similar segments that also do not qualify for the purpose of meeting the 10% test. As you can see right here, we use the revenue approach in the 10% threshold test. The table shows each business segment's revenue consisting of external revenue, internal revenue, and the total revenue for the calculation of the 10% threshold test to determine whether the segments are reportable or not. The business segments are construction, information technology and e-commerce related business, hotel operations, cement and building materials industry, property investment and development, management services, and others. Since we use a revenue basis for the threshold test, the total revenue of one segment will be divided by the total revenue amount of all segments. Then, the amount will be compared to the 10% total revenue. If the amount is equal to or more than 10% of total revenue, therefore the segment will be considered as a reportable segment. Now, from our calculation, on the 10% threshold test, the business segment of cement and building materials industry and utilities passed the test and qualified as a reportable segment with a percentage of 23.16% and 59.58% respectively. Meanwhile, the segment of construction, information technology and e-commerce related business, hotel operations, property investment and development, and management services and others do not meet the criteria of the 10% threshold test to be a reportable segment. In this slide, I will continue with going through the clarification of the 75% threshold test. First and foremost, based on the last slide, to clarify and determine whether the segments of a company is reportable or not, it must pass the 10% threshold test, where the internal and external revenue from each segment must be equal or more than 10% of total revenue from all segments in revenue basis. Accordingly, the 75% rule is another test that is needed in order to determine whether you identify enough reportable segments based on the quantity test, and this can be done by recognizing if the total revenues from external sales in the reportable segments are at least 75% of the consolidated revenues. If it is not, then you must disclose the information on additional operating segments until you meet and or exceed the 75% threshold test. The operating segments that you are going to add must be the next largest segment. Moreover, if the segments have similar economic characteristics, then they can be aggregated into a single operating segment and considered together. From the table next to me, the working for 75% rule is by taking the total revenue of the reportable segment, which is cement and building materials industry and utilities segment, amounting of 14,665,626,000 will be divided with the total external revenue that we have calculated in the 10% threshold test, amounting 17,270,419,000, and it seems that the total attributable to reportable segments of YTL Corporation does pass the requirement of 75% test, which is 84.92%. To conclude, I will talk about the advantages and disadvantages of segment reporting. Let's start with the advantages of segmental reporting. Firstly, segmental reporting will give a better understanding of financial statements. Therefore, we get to see the company's performance clearly. Moreover, the profit-making and loss-making units can be easily identified with the help of segmental reporting. Nevertheless, it also helps in the optimum utilization of resources and better presentation of the financial statements. Additionally, segment reporting also helps with potential investors in better investment decision to evaluate the company's performance in the future. Now, moving on to the disadvantages of segmental reporting, there are tons of disclosures required in the case of segmental reporting. Hence, it is a time-consuming process. To begin with, the data presented in segmental reporting can be misinterpreted by the investors or creditors in the company, and it will lead to misunderstanding. Furthermore, the method used by segmental reporting of inter-segment transactions are different from each organization. What's more is that the base of the segment is also different, as some organizations divide the segment based on geographical location, and some organizations divide it based on product-wise. Finally, the common costs are sometimes difficult to allocate in segmental reporting. That's all from me. Now I will pass on to the next presentation to explain about the interim report.
Thank you, Ami. Now I shall start with the part B, which is interim report. On the first slide, which is basis of preparation of the interim report. Content basis is the minimum component of the interim report, where it should at least include a content statement of position, a content consolidated income statement, content consolidated statement of comprehensive income, content consolidated statement of financial position, a content consolidated statement of changes in equity, a content consolidated statement of cash flow, and lastly, a selected explanatory note. YTL Corporation Berhad use a content basis of basis preparing their interim report as stated in their fourth quarter interim report for the year ended 30 June 2022. YTL Corporation Berhad use the term content consolidated due to the interim report is unaudited and has been prepared in accordance with the FAR570. 134. YTL Corporation Berhad content consolidated interim financial statement should be read in the conjunction with the audited financial statement of the group for the year ended 30 June 2021. On to the next slide, I will talk about two accounting policies used in preparing the interim report are MFRS 16 Lease and MFRS 116 Property, Plant and Equipment. The first accounting policy is MFRS 16, where it previously stated MFRS 117. MFRS 16 eliminates classification of lease by the leases. All lease will be brought onto its balance sheet as recording certain lease as off-balance sheet lease will no longer be allowed except for some limited practical exemption. MFRS 16 requires leases to recognize the right of use of the underlying asset and at least liability reflecting future lease payment for lease. YTL Corporation Berhad apply MFRS 16 using a modified retrospective approach. The impact of applying MFRS 16 for the leasing contract assessed to be relevant to MFRS 16 as at 1 July 2021 is adjusted to YTL Corporation Berhad written earnings as at 1 July 2021. For other accounting policy is MFRS 116 Property, Plant and Equipment, which is prescribed the accounting treatment for property, plant and equipment so that user of the financial statement can discern information about an entity investment in its property, plant and equipment and the changes in such investment. The principal issue in accounting for property, plant and equipment are the recognition of the asset, the determination of their carrying amount, and the depreciation charge and impairment loss to be recognized in relation to them. Property, plant and equipment of YTL Corporation Berhad are being measured as its cost model, which is the cost less accumulated depreciation and accumulated impairment loss. The depreciation method used is a straight line basis and a rate required to write off the cost of the property, plant and equipment over their estimated useful life. Now moving on to the next slide, which is type of interim report prepared by the company. There are few types of interim report used by YTL Corporation Berhad. The first one is content consolidated income statement. The second one is content consolidated statement of comprehensive income. The third one is content consolidated statement of financial position. The fourth one is content consolidated statement of changes in equity. And the last one is content consolidated statement of cash flow. That's all from me. Now I will pass to the next presenter. Thank you.
Next, we will move on to the current and comparative of each statement prepared by the company. The financial statements are prepared based on the quarterly interim report. The financial report shall be measured from the 1st April 2022 until 30th June 2022, which is equivalent to the 4th quarter for the financial year 2022. Okay, now let's begin with the first financial statement in the quarterly interim report, which is the statement of financial position. For the current interim, the reporting period is 3 months and it will start from the 1st April 2021 until 30th June 2021. For the comparative end of the year report, the reporting period is 12 months and will begin from the 1st July 2021 until 30th June 2022. Okay, next is the statement of profit or loss and other comprehensive income. For the current interim, the reporting period is 3 months, which start from the 1st April 2022, ended in 30th June 2022. And for the cumulative year to date, the reporting period is 12 months, and that will begin from the 1st July 2021 until 30th June 2022. As for the comparative current interim, the reporting period is 3 months, which will begin from 1st April 2021 until 30th June 2021. As for the comparative year of date, the reporting period is 12 months that will begin from the 1st July 2020 until 30th June 2021. Okay, next is the statement of changes in equity. The reporting period for cumulative year to date is 12 months from 1st July 2021 until 30th June 2022. For the comparative year to date, the reporting period is 12 months from 1st July 2020 until 30th June 2021. The last statement is statement of cash flow. The reporting period and the reporting date for the cumulative year to date and the comparative year to date is similar to the one as shown for the statement of changes in equity. The reporting period is 12 months and the reporting date is 1st July 2021 until 30th June 2022 for the cumulative, and for the comparative is 1st July 2020 until the 30th June 2021. There are two adjustments made by the company to be included in the interim report, which is additional asset and sale and leaseback. For the first adjustment made by the company, which is an additional asset, the company's assets are based on the straight line method. The depreciation rate is 10%. The maintenance cost of the property, plant and equipment is 70 million and no depreciation was recorded. The cost of the plant and machinery is RM27672264000 and accumulated depreciation is RM13750415000. For the depreciation of property, plant and equipment from the first quarter to the third quarter are the same as the adjustment is made in the fourth quarter. Then, to calculate the carrying amount of the property, plant and equipment as at 30th June 2022, the cost of PPE needs to be deducted by the accumulated depreciation after adjustment, which result in a carrying amount of RM11224,622.60. As you all can see here is the extract of the comparative statement of financial position as at 30th June 2022 for the company YTL Corporation Berhad, which result in an increase in PPE at RM320229114000. The second adjustment is sale and leaseback. The company entered into a sale and leaseback agreement with Mentari Berhad. The carrying amount to be sold and leased back was 87 million ringgit. Fair value of the building was 102 million. Present value of leaseback payment was 69 million. Company sold the building for 94 million to Mentari Berhad. As shown in the slide, the journal entries record the second adjustment as soon as the corporation entered a sale and leaseback with Mentari Berhad. The cash account increased as the company received cash from the Mentari Berhad to finance this project. This liability can also be decreased from 69 million to 61 million because selling price 94 million is lesser than the fair value of 102 million, and the difference will be set off against the lease payment of 69 million. This adjustment can also benefit the company as it can increase the profit of the company as there is a gain on the sale of the building. This table shows the extract statement of financial position for the fourth quarter as at 30th June 2022. Show the effect of after and before the adjustment, as we can see the property, plant and equipment it decreased by 87 million. Right of use increased by 58,853,000. Cash and bank increased by 87 million and lease liability increased by 8 million. Okay, that's all from us. Thank you.